Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. I'm Doug Krisner in New York, along with my colleague Mary Nicola, MLive strategist, joining us from Singapore. Tim Mo is with us. He is the Chief Asia Pacific Regional Equity Strategist at Goldman Sachs. He's on the line from the Lion City. Tim, always a pleasure. Can we talk about Alibaba, not specifically as a company, but in the context of what's happening on the mainland, where there seems to be a bit of positivity related to AI. However, when you look at e-commerce, things are not great.
Well, first of all, thanks for having me on. I think that in many ways the question you've asked is emblematic of what is taking place in the Chinese equity market and fundamentally. So just stepping back, the broader picture is that the platform companies in general are reporting decent earnings, better earnings, certainly than many other parts of the market. So in larger terms, it's a bright spot. Alibaba's numbers were somewhat softer, for example, than Tencent's. Ronald Kung, who's our internet analyst, has been writing extensively about this and has lots more detail, which we can share with you perhaps another time. But the key point is that I think the underlying spending and appetite for consumption in China certainly is soft and under pressure. That has led to people trading down to greater focus on conserving expenditure. Household savings remains well above 30%, household savings as a percent of household income. And I think that's all a reflection of subdued risk appetite, which is a function of the fact that the economy has slowed and that people are feeling perhaps less secure about either current income, there's a wealth effect from property, and also we see some concerns about job stability. So all that has led to trading down, which of course then filters through to a focus on cheaper products, and that's compressing margins, and we've seen that show up in Alibaba's numbers. So I think that's really sort of the broader narrative which is taking place.
Tim, this is Mary in Singapore. Just a question on how do you see the earnings outlook for this quarter and for the next quarter as well in China?
Sure. So we actually just published a piece yesterday, and we've taken our numbers down for the onshore so-called A-share market down to 6% earnings growth for the full year this year. That's pretty meaningfully below consensus. We're somewhat more constructive on the offshore segment, but still below consensus there. We're about 8% for the offshore MSCI China index as compared to 6% for the CSI 300 onshore A-share index. Consensus is still up in the low teens, and we think is unrealistically high. I'd say maybe the better news from an equity market perspective is that the buy-side investors that we speak with generally are in tune with our numbers. So even though we think there may be some further downgrades to consensus sell-side earnings numbers, we think that's pretty well in the price. And in fact, if you look at China's valuations as of the close yesterday, the MSCI China index is trading at 8.8 times forward PE, and the CSI 300 trading at 10.9, and those are about a standard deviation below the longer-term mean. So market certainly is pricing a lot of concern and negativity, but I think we really need to see the underlying earnings stabilize and come through in order to see the market regain its footing and regain upward traction.
So yesterday, as I'm sure you are well aware, Tim, we had the monthly activity data for July. Industrial output was up at annual rate of around 5.1, a little bit below what we had in June. I think that increase was 5.3. One of the things that has been a bright spot, and I'm curious to get your take on whether it's going to continue, is the export economy in China. Do you expect it to hold up?
Well, the quick answer is yes, but you also raise an important point, which is that China is currently tracking somewhat below, but roughly in line with its about 5% policy declared growth intention. However, as Hui Shan, who's our chief China economist, and our econ team more broadly have been noting, that growth is imbalanced. And the question you raise is the appropriate one, which is that the export side of the economy is doing quite well, whereas the domestic demand economy, which is your previous question relating to Alibaba, is still quite soft. So we really think that there needs to be a greater sense of policy support, dare I say urgency, in terms of supporting domestic demand. Now, there has been some effort to lean in that direction in a variety of ways to support domestic consumption, but we think that more is needed, especially in the context of the undeniable export success which China is enjoying. But that comes, of course, at a time when there may be more pushback from the countries that are receiving China's exports, given the current geopolitical environment and the desire to protect domestic markets. So if the overall plan or intention is to repeat the success of, say, 20 years ago in the period following China's accession to the WTO in December of 2001, following which China enjoyed very significant market share gains externally, which then drove very significant economic growth, it's unlikely that that playbook will be able to be repeated to the same extent in the current environment. So that, again, cycles us back to the need to support domestic demand.
Shifting gears a little bit to Japan equities, we've seen extreme moves over the past week or so. Do you think that we climb back to the highs, or do you see a deeper correction that is coming through in Japan?
Well, you asked a great question, because I was actually just looking at that this morning, and here are some numbers that I think are very helpful to keep in mind. That Japan, looking at the Topics Index, basically corrected 24% from the July high to the low on Monday last week, and then it's since recovered as of yesterday's close about 20% from that low, and it's still down about 9% or so from that previous peak. So there's been significant and severe volatility. The greatest, or the second greatest, one-day fall last Monday, down 12%. The bottom line here is that we remain constructive on Japan equities. We think that they got significantly oversold because of position unwinding and the much-discussed Japanese yen carry trade, and some crowded foreign positioning in some of the leading index stocks. But we think a lot of that is cleared. There's some evidence, a decent amount of evidence that the Japan carry trade, at least the more speculative part of it, has unwound to a pretty consequential degree. And I think if we focus ourselves again on the core fundamentals, which are that earnings growth has come in actually quite strongly for the first two quarters of calendar year 2024, we're looking at high single-digit earnings growth for this year and for next. The Topics Index got down to 12.2 times forward earnings.
Mm-hmm. Tim Moe from Goldman Sachs, thanks so much. This is Bloomberg. This is Bloomberg Daybreak Asia. I'm Doug Krisner at the Bloomberg Interactive Broker Studio in New York, along with my colleague Mary Nicola, MLive strategist, joining us from Singapore. And our guest is Vance Howard, CEO and Portfolio Manager at Howard Capital Management. Vance, good of you to join us. What did you make of today's eco data? It seems to suggest we're on our way to kind of a soft landing here.
Well, we hope that we are. And, the numbers keep coming out. Some weeks it's good, some weeks it's not so good, but it appears that inflation is dropping like a rock. It appears like it's going in the right direction. I think we're going to get a cut here pretty soon in September. It's going to be kind of interesting to see Powell's tone at the Jackson Hole meeting in the last week of this month. So we'll see what kind of tone and kind of verbiage that he spits out there.
So, Vance, how are you positioning for this? How are you looking at the volatility? Are you looking through the volatility? And what do you expect from equity markets in the next 3 to 6 months?
Well, that's an interesting question, because we were talking about the market being frothy before it started to drop. This was 2 or 3, 4 weeks ago, and we expected a pullback. Now, I've got to admit, we didn't expect a pullback this hard or this deep. It was pretty eye-opening, to be quite candid. But the carry trade, I think this carry trade was a really big issue, especially after that bad jobs number came out 2 weeks ago. And I think that drove the market really lower. So it stopped us out of a few positions. So we built up a modest amount of cash, not very much, but the trend's still up. The HCM byline's positive. To be quite candid, I think we'll hit a new high on the S&P by the end of the year. I think it's a very bullish market, even though we've had a pretty nasty 10% correction, but they're common. So these are one of the things that happens.
So in terms of areas of the market that you would like to focus on, are you moving away from, let's say, mega cap tech and into some of those economically sensitive areas like materials or industrials, or do you think that trade is pretty much run its course and it's time to look at other strategies?
Well, no, I think the Magnificent Seven are going to continue to do well. But I've also noticed, and I noticed you've noticed this too, the high dividend paying stocks like DVY and some of these ETFs that are dividend paying equities, they've started to really ratchet up and start to do better and better and better. So we've been adding more exposure to high quality dividend paying stocks over the past couple of months, especially in one of our fund Dividend Plus. But that's been a very good place to store some money. It's holding up very, very well with this 10% pullback. It didn't pull back very much at all, and it's about to make a new high on some of these dividend-paying stocks. So I think that you should look for some of those income-producing areas.
So seems like you're focused on dividend-paying stocks. How are you viewing small caps like the Russell 2000? We've seen they've had some good runs. They've had some setbacks. What's your view?
I've been saying that people ought to start diversifying into small caps over the past 4 or 5 or 6 months, and I've been a little bit early on that trade. But if you look at interest rates, if they pull interest rates back in September, and if they make other additional cuts throughout the course of the year, that's going to benefit small caps because that's going to add to their earnings because they're very dependent. They're sort of interest rate dependent. So I think small caps could be the come from behind horse here for the last 3, 4, 5, 6 months of the year. I think you can see small caps really explode to the upside.
When you have conversations with clients, the concerns that they have right now, I'm interested in hearing from you. Could you help me understand what really creates anxiety right now, or are they pretty sanguine on what's going to happen in terms of future gains for equities?
I think most people are pretty positive. I mean, if you look at the cash buildup, there's over $6 trillion worth of cash on the sidelines. So that means there's a lot of buying power that can go into equities over the next 1, 2, 3 years that could make this bull market last for quite a long time. Most of the individuals that I speak to are business owners and wealthier individuals, and they're very, very positive on what's taking place. Inflation has been sort of a drag on everything, but it seems to be correcting itself. It's dropping. Interest rates should be dropping. So I think you've got a really good catalyst here for a very good, strong bull market, especially the last quarter of the year. I think that could be, pretty nice part of the year.
So you've talked a little bit about how there's a lot of cash sitting on the sidelines. What do you think it'll take for more of that to be deployed into equity markets?
If they start dropping rates, I think you'll start to see it moving into equity markets too. And if you look at the 1 or the 2 or 3 year treasuries, if they start to drop rates there too, that's going to bring down the interest in those areas of income producing products. So you're going to see that go back into the market also. And I think that's one reason that we're starting to see dividend paying stocks do so well is that money is starting to shift over into those type of equities.
Is the U.S. the only place you want to be right now? Are you looking at diversification in offshore markets at all?
I'm not right now, and the reason being is our markets have been so healthy, especially the past year and a half, so there's really no reason to look overseas when there's so many opportunities right here. Our markets are incredibly well regulated and they're incredibly liquid, so there's really no reason to venture over the pond when you have so many great opportunities sitting right here in your backyard.
And what are your thoughts on treasuries at this point? Do you think, and how soon do you think we get a cut from the Fed?
We started buying treasuries, I guess, about 4 or 5, 6 weeks ago, and we started modestly adding on any dip that treasuries have. But we're getting more and more bullish on treasuries, and if they dropped rates, you should see the value of the treasury bond move up. Now, of course, the interest rates are going to go down, but I think that treasuries are sort of something that people really need to start looking at as a tradable instrument now. They're highly liquid, and they actually can produce some positive capital gains if you're looking for growth of capital.
You're in the state of Georgia. Looks like it's a swing state. We've got a presidential election a few months away. Yeah, that's a big deal, I think. And the outcome could have economic ramifications. Wouldn't you agree? I mean, do you have a view, not so much on this race, but on what it may mean for the market going forward?
The one thing that does disturb me is they keep talking about raising capital gains rates, and I'm not bullish on that at all. I think that's going to be a very big hindrance to real estate, to investors, to stock investors, real estate investors, bond investors. I think it's just going to be a very big hindrance. I think that's a very negative. So I'm very much anti, raising the capital gains tax. So, this it's going to be pretty nauseating and quite candidly up until the very end. I'll be glad when it's over, and we'll see. We'll have to trade the market that we have, not the one we wish we had.
So from your end, you seem very positive on equity markets, but what keeps you up at night? What concerns you?
Well, what concerns me is number one, the national debt. I think the national debt is incredibly disturbing. It just keeps going higher and higher and higher. And that is going to be a tipping point. When that breaks, you are going to see the economy and you're going to see a lot of things that are really going to tumble. And it's going to damage a lot of people, not only in our country, but throughout the world. So our national debt's a very big disturbance. And then also, you look at some of what China's doing. China disturbs me to some degree. So, need to sort of watch on what's going on in the Far East.
55.43. That's where we ended the day for the S&P 500. Vance, 10 seconds. What's your year-end target for the S&P?
We'll make a new 52-week high this year. We'll be over 5,700 on the S&P, in my opinion.
All right. Pretty bullish. Vance, thank you so much for making time to chat with us. He's Vance Howard, CEO and Portfolio Manager at Howard Capital Management from Roswell, Georgia, here on Daybreak Asia. Let's get to our guest. Terri Spath is with us, founder, chief investment officer at Zuma Wealth. Terri is in Malibu, California. It's always a pleasure to have you on the program. Thanks for making time to chat with us.
Well, thank you, Doug. It's always a pleasure to be on here.
All right.
I hope you're having a great summer in New York.
Yeah, we are. It's a little humid, but that's to be expected. Less so the case in Malibu, right? Right on the Pacific Ocean there. I'm sure you've got a great view. Talk to me about the idea of a soft landing. The day's economic news seems to be lining up on that trajectory. Is that your bet?
Well, I'm not sure it's my bet. It's certainly the market's bet after today. Investors can be forgiven for feeling a little bit paralyzed and reacting very quickly to some of, what's been some nice news recently. The retail number that came out today was perceived as a Goldilocks, sort of not too hot, not too cold. The consumer's holding up, but there's still some sticky inflation out there. There's still some pushing and pulling on the data. And, in our view, the economy is doing just fine. Does that mean it's not going to be bumpy in this landing that's probably coming between now and year end? It'll probably be bumpy, and that injects volatility into the market. So, that creates opportunity. That creates opportunity when we see some of those downdrafts and big up days. You can enjoy the upswing from that.
Terri, this is Mary in Singapore. I want to bring you to this side of the world. Japan, obviously, we've seen immense volatility over the past week or so. How do you think the stock market plays out? What do you think do you see a continued surge in the Nikkei? And how do you see what's your view over the next 3 to 6 months?
Yeah, Japan's been really interesting, hasn't it? I mean, you're even closer to it over there in Singapore, but and I do think that I'm glad you brought up that topic, because I think over here in the United States, most people are underweight Japan, most investors, and there's a lot of opportunity there. The decision by the Bank of Japan to hike rates basically at the same time that the United States released soft economic data really drove that surge in the yen that we saw a week or two ago, and that injected a lot of instability. And so after a very strong period for Japanese stocks, there's been volatility, there's been a pause, but the structural changes that are underway in Japan, the slashing of regulations, the cutting of corporate taxes, and a lot more, I think that those are still very underestimated here in the United States, in our view. There's very much of a bias for home country, and at least you should have a 5% allocation to Japan. That just makes you market weight. Any hesitation like we've seen in stock prices for the broad Japanese market is an opportunity right now. It's still below where it was very recently. The valuations are still very good. And so we think investors should take advantage of that volatility and make sure that they have at least market weight and ideally an overweight position with exposure to Japan.
So just a follow up here. So what do you think are the implications of a weaker yen on corporate earnings? Because we've heard a lot about how companies have benefited, companies like Toyota have benefited from a weaker currency. So what do you think are the implications of a much stronger yen?
Of a stronger yen. Yeah, I mean, that would create a headwind, a weaker yen, a weaker currency for most companies that have international operations. That creates tailwind. So if the yen gets stronger, which is a fair probability if their interest rates are going up relative to the US, which is probably a good chance. But there are so many other tailwinds essentially going on in Japan on a structural basis that we think that outweighs the risk of the problems that a stronger currency creates for Japanese companies. So while, I think you bring up a very good point, and I think people should be aware of that, I don't think that changes our general thesis for the strength of that country and the structural changes that are really so exciting after a long time of not being exciting for Japan.
No joke. I mean, it was very impressive, the reading on second quarter GDP the other day at 3.1. I mean, the street was only looking for 2.3. And I was particularly impressed at that figure because if you consider the fact that Japan's largest trading partner is China, and we know China continues to struggle, the fact that Japan has been doing so well is even more impressive in that context.
It is. And that brings up an interesting point because we are very negative on China. And that's, again, that can create some problems for a lot of their trading partners. And we're a hard no on China. I mean, the problems there are also structural. They're producing way more output than the world can begin to absorb. That means Chinese companies have to cut prices. That means falling profits. It's like this doom loop of falling prices, factory closures, insolvency, job losses. It's just, it's not good. And it's going to take a long time for those implications to switch to the positive. So, negative on China, make sure you're exposed to Japan. That's really one of our big messages for our investors.
Good messages to have. Thank you so much, Terri, for making time to chat with us. Terri Spath from Zuma Wealth and Malibu, California. That's where Terri happens to be. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.